Thanks for joining us for this month's market update for the month of January 2025. Obviously, there's a lot going on in the markets. Recently, tariffs have been dominating headlines. There was also a couple weeks ago some pretty major news in the AI world as it relates to a new company out of China called DeepSeek launching a new AI bot. So there's lots to unpack in today's market update. The written market update, if you want to read that, is going to be a little bit more extensive and really tackle the tariff issue in more detail if you want to parse through some numbers. But we'll try and give you the Coles Notes version in today's market update as we go through it. But overall, January was a pretty solid month despite some uncertainty recently in the news as it relates to tariffs. Canadian stocks, as measured by the TSX, closed January up 3.26%. However, the loonie did continue its slide versus the US dollar. The loonie depreciated 2.43% in January versus the US dollar and has depreciated 4% in total over the past 3 months. The U.S. stock market, as measured by the S&P 500, again experienced some intra-month volatility, especially as it relates to the DeepSeek AI bot that was launched in China. NVIDIA fell 20% in one day, and it impacted some of the other magnificent tech stocks. But by the end of the month, most of those stocks ended up bouncing back somewhat, and the overall U.S. stock market was up 2.7% in January. Obviously, the biggest issue of the day, especially as it relates to Canadian investors, is Trump's tariffs, which have, as of writing today on February 3rd, have now been imposed. So, Kevin, maybe you can give a little breakdown for our viewers on the Trump tariffs.
Yeah. So first I wanted to start by kind of explaining what a tariff is and how it affects the different markets. We have gotten a number of questions about this. So when the U.S. imposes a 25% tariff on products coming into the U.S. from Canada, that means that the importer in the United States is the one that pays that 25% tariff, and then they have a decision to make as to trying to absorb part of that against their profit margins or just passing that on to the end consumer. And just the same as Canada putting in tariffs against U.S. products means that the importer in Canada pays that 25% tariff. So the Trump administration announcing these tariffs that started yesterday, or on Saturday, February 1st, means that products going into the United States are now hit with a 25% tariff from Canada. Now, China also received a tariff of 10%. Mexico received an equivalent 25% tariff. The only difference on Canada's was our energy imports or exports to the United States are only being hit with a 10% tariff. Now, Canada has retaliated with tariffs of its own, and they're going to come out in 2 different phases. The first one is going to start tomorrow, February 4th, and will be a 25% tariff on roughly $30 billion worth of products that come into Canada. If we continue moving forward with the tariffs, our second phase will start February 25th, where we will implement the same 25%, but it will be expanded to cover $125 billion worth of product ranges that come in from the United States. So David, what is Trump trying to accomplish with these tariffs?
Well, I think the 2 main goals he stated fairly clearly, but he's been somewhat ambiguous as to what we need to do to have him stop the tariffs. So obviously he's talked a lot about border security as it relates to the southern border with Mexico and the northern border with Canada. He's not been happy with the amount of illegal immigration that's happening into the United States. I think, again, more so from the southern border, but he's lumping us in with Mexico in that regard, and as well as illegal drugs, fentanyl flowing into the United States from Canada and Mexico. Again, the amount of illegal drugs flowing in from the northern border pales in comparison to what's flowing in upwards from the southern border, but nevertheless, we're being slapped with the same 25% tariff as Mexico is. And so I don't believe that it's purely border security that is driving the tariff issue with Trump. He's also mentioned many times over how he doesn't like the trade imbalance with Canada. He's obviously jokingly or not threatened, that Canada should be the 51st state and that the U.S. should stop subsidizing Canada. He's come up with a $200 billion number several times. Again, when you read through our market update, you can parse through the data. It's not immediately clear how he's coming up with a $200 billion figure, but that trade imbalance that the U.S. does have with Canada really largely owes to the U.S.'s outperformance as an economy. You know, they consume a lot, and so they can't produce all the things that the U.S. consumer wants, and therefore they need to import things, largely our energy. And again, they do get that at a discount based on the currency differential between the U.S. dollar and the loonie. So, you know, we're not exactly clear as to what the economic impact of tariffs is going to be, but it's clear that it may impact Canada more than the United States. Trump obviously wants to try and do what's best for his country. He wants to protect U.S. business at the expense of other countries' businesses. He also wants to cut U.S. corporate taxes, and so he may view the tariffs as a revenue-generating opportunity by which he can generate revenue where he's losing it on the tax side, and he can also theoretically protect U.S. businesses by maybe forcing U.S. consumers to want to buy more U.S. products at a lower price versus products that are being imported from Canada and Mexico. But this remains to be seen whether it's actually going to be an effective policy for the U.S. So Kevin, how will tariffs impact Canada?
Well, Canada has a large amount of exposure and reliance on the U.S. economy. Roughly 75% of our products that we export go to the United States, and roughly 64% of our imports come from the United States. So there's a heavy reliance on them as a trading partner for us. And look at the chart on the screen, you can see that in the first 3 quarters of 2024, roughly $800 billion of goods crossed the Canada-U.S. border. Including trade and services, boost these totals to just over $900 billion, which is the equivalent of $3.6 billion in total import and export flows each day. Only Mexico edges out Canada. But when it comes to which country dominates in buying American products, Canada is the single largest market by quite a large margin, with nearly $350 billion in goods and services crossing Canada's border over the first 3 quarters of 2024. Some 34 U.S. states sell more goods to Canada than any other foreign economy. So as you can see by those figures, at the moment Canada is pretty reliant on the U.S. as a trading partner, but the longer this goes on, it does create the opportunity for Canada to start looking elsewhere for new trading partners and diversifying who we're dealing with, so that if this does continue for a long while, or if it ever comes up again, we aren't hit so impactfully because we'll be a bit more diversified and able to handle this better. David, how are these tariffs going to impact the markets?
Well, probably there's going to be some headwinds to stock markets in the short term as investors are parsing through what the potential impacts of these tariffs are going to be on the respective economies, who's going to be the bigger winner and or loser, or is everyone going to be a bit of a loser with tariffs having been paid. We just don't know right now. But clearly over the weekend when the tariffs went through on Saturday, the market futures heading into today, February 3rd, which is a Monday, the futures were open, the markets opened roughly down 2% in Canada and the US to start the week. But quickly intraday, the markets in the U.S., the S&P 500 is only now down about 0.5%. Canada is down about 1%. So there's been a bit of a bounce off that initial low. And again, clearly the situation is fluid. The reason for the bounce is that there's recently been a report that Mexico and Trump were talking, and Trump's agreed to stay the tariffs on Mexico for about 1 month. So that's part of the reason why the markets have bounced. There's maybe some optimism that the tariffs aren't going to be all sweeping and that there's still negotiation happening. So we just don't know. It's impossible with markets to predict exactly what's going to happen, and more importantly, when it's going to happen and how to trade off of that. So it's important to maintain perspective at this point in time, that short-term fluctuations in market prices and the stock market aren't really long-term drivers of 5-year returns, 10-year returns. There's definitely going to be a lot of noise over the coming weeks, and certainly over the next 4 years as we deal with Trump 2.0. But that's just going to be par for the course, and investors are going to have to learn to live with that volatility in order to get the long-term returns that the markets have always given us. Kevin, are there any potential opportunities that could arise for investors as a result of the tariffs?
Absolutely. One of the positive things volatility does bring is opportunities. We may see different underperforming assets and sectors kind of benefit from the shifting dynamics that we're seeing. Canadian assets have underperformed US assets recently and for a fair bit of time, to be honest. And so global equity or global balance mandates within client portfolios of ours have underweight Canada and the Canadian dollar for quite some time. And they've been overweight in the US, which has been a good thing. We've seen a lot of growth because of that overweight. But as time goes on, if a lot of these Canadian companies continue to underperform due to the tariff situation that we're seeing, even though they are good companies, these become opportunities for these fund managers to kind of scoop up while they're a bit undervalued because of the long-term growth potential that they may have. So just because we're overweight the US today doesn't mean we're going to be overweight tomorrow. And I think as time goes on, as I mentioned, if the Canadian companies continue to underperform, you'll see the Canadian portions of your portfolios increase a bit over time as they get scooped up as good deals.
In January, the Bank of Canada cut interest rates another quarter point, its sixth consecutive interest rate cut. And while that's a good step towards trying to bolster growth in Canada, obviously the tariff issue is looming over the Canadian economy, and it is going to be a headwind if we face these tariffs for any length of time. Now, Trump 2.0 has started in a bit of a frenzy, with a whole bunch of executive orders being signed, these tariffs coming to fruition. So this is likely going to continue over the next 4 years as we have to deal with President Trump and, sort of erratic policy that can turn on a dime as well is just something that investors are going to have to expect and learn to live with. There's probably going to be, more headlines. Trump's a bit of a headline hog. That's not going to change. He likes keeping people guessing, keeping his allies and his enemies guessing. And so that's just something that we're all going to have to live with. And it's probably going to make investing a little bit more difficult over the next 4 years. It's going to be, investors may be prone to make knee-jerk reactions, which again, we never advocate for. But point being is we're always here to help you understand what risks your portfolio has embedded within it. Also what rewards you can reap by staying invested in your portfolio, and just help you understand how your portfolio is positioned. So as always, if you have any questions or concerns, never hesitate to reach out to Harry, Kevin, or myself.
Take care.